Hello and welcome to this video on the 3 ways that double entry bookkeeping store and why 2 of them probably aren't working. If you're struggling with it, you're not quite getting it, it could be that you've been taught with one of the 2 methods of that won't probably work, and we'll go through today the one which will work for you. So we've got 3 methods. We've got the money in, money out method. That's the one that I sort of teach really, and that's the one that works most effectively. We've got the leftover method. And we've also got as well DEAD CLIC and Fails. So those are the 3 methods we're going to go through, and we'll see why these 2 don't really work. So the money in, money out method is that basically the company's a box. So imagine the company's a box, and double entry bookkeeping is from the company's perspective. All money that goes into the box must come out of the box. Okay, so all money that goes into the box is the company's assets, and all the money that must all go out to liabilities and the shareholder, whatever's left over goes to the shareholders. So we got the company's assets in here, and assets are anything that is money now, so cash, or money that's going to be converted to money in the future. Something that's going to be converted to money in the future. So we've got some stock and we've got some van that we're going to use to do our business. So all money in the company now, either now or in the future. And that's got to go somewhere. So all this money that's in the box has got to go somewhere eventually. So first of all, it goes to pay off our liabilities, so the bank and our suppliers, and then anything that's left over goes to our shareholders. So, and this is the same. There's no why would there be any sort of surplus money that's sort of created or whatever? Because the shareholders own the company. So if there are any surpluses, well, they want it. Imagine we're shutting the business down. We're stopping it there though. Yeah, we pay off. We convert everything to money, we pay off our bank, we pay off our suppliers, anything that's left over the shareholders get. Why would they leave anything else behind? So we have this sort of idea then in the money out method, that all money that goes into the company must eventually come out, and that means that assets, all money in, either now or in the future, must be equal to liabilities, things to the bank, suppliers, and like that, plus shareholder capital. Anything that's left over goes to the shareholders. So that's how this method works, the money in, money out method. And then we have our debits and credits in the money in, money out method. So from the company's perspective in this one here. That means also as well for sole traders that it is the companies, the sole traders. It's not actually the sole trader themselves. If they're a plumber or whatever, they're irrelevant. They're a shareholder, essentially. They're the owner. It's from the company's perspective. Plus money, money in, now or in the future. Debit, minus money, money out now, money out in the future, credit. So we get this nice little diagram here. Assets equals liabilities plus capital. And we've got if assets go up, so bank goes up, we buy a van, the van goes up, then that's plus money. Minus money, so we bought the van from the bank, the assets going down, minus money in the bank, credits. And then in terms of liabilities going up, so shareholder pays money into the company, alright, it goes into the bank, debit bank, that's going up, but the shareholder wants their money back in the future, the shareholder's going up, that's increase in credits, minus money. Reduction in liabilities, let's say, is plus money. That liability going down, that outflow of money going down in the future. So let's say we pay off VAT account, we've gone, we got minus our bank, what we paid. It's an asset going down, minus money, credit. But we've got a reduction in our VAT liability, money going out in the future, debit. And the reason why this really works very well is not only have we got this nice sort of thing going on in terms of how we understand our debits and our credits, but it also lines up nicely as a T account, with our debits on one side and our credits on the other. So that's the advantages of the money in, money out method and why it works so well. Let's now do the leftover method. Not quite as good a method as the money in, money out. Not a bad method, not a terrible method. And so in the leftover method, we start from the point of view of the shareholder, and so anything that the shareholders own anything that's left over in the company. So they start with this method here, which is assets. Whatever the company's got into its assets, we take off any liabilities, and whatever's left over goes to the shareholders. So it's an explanation of the reason for the accounting equation. That's its one big advantage of it. It's understandable. We've got some assets in the company, we've got some liabilities. We pay off all those, and we share capital. So it's great for explaining the balance sheet. But why doesn't it work? Well, because double entry bookkeeping should be from the company's perspective, not the shareholders. The shareholders just simply a liability in double entry bookkeeping, just one whose liabilities go up and down depending upon profits. So we have this other thing that what tends to happen when students get confused about this method. Well, what happens when a transaction doesn't involve shareholders? So we're just paying off the VAT, let's say. Well, what happens there? Well, there's no shareholder effect there, is it? It's credit bank. We're reducing the bank, and it's debit the VAT because we're reducing the VAT liability. No effect on shareholders on that one. It's simply a balance sheet transaction. So it doesn't really sort of starts to break down for students when they're not seeing an impact on shareholders. And then we got the other one, which is it's not really explaining. It's explaining it from the shareholders' point of view. Shareholders, often have bank statements, and people then struggle to understand. Well, hang on a second. If I've got a bank statement and I sort of get a payment into my bank statement, then that's put as a credit. And if I've got a payment out, that's a debit. But that's the opposite of what happens from the company's accounts. And there's reason is because the bank statements from the bank statement's perspective, the company's accounts are from the company's perspective, and so they're the opposite way around. So, well, you can just split the bank statement around, But as soon as you start to get into situations of systems where you've got yeah, but then you can start to see how it breaks down. So. And then we start to have that difficulty understanding that the shareholders, or a sole trader especially, is an outflow of money to the shareholders. So a payment to a sole trader, and they're taking money out of the business, a reduction in bank, credit bank, and really it's then debit drawings, isn't it? Well, it's very hard to sort of see that, because if we're setting up a position from the shareholder's perspective, and the shareholder getting money is positive, well, is that debit? Is that credit? Well, so it's trying to get over this idea of the shareholders really are bad. They're an outflow, they're a liability. So let's say we're paying the money in from the shareholders. Here we got debit bank, money going into the bank, credit capital, the shareholders. But shareholders getting money, shareholders good. Why is that not good? Debits are good. Okay, it's not really, is it? So that's why it doesn't work. It also as well is not lined up as a T account. So here we got this here, assets minus liabilities equals capital. Is that a T account? Well, it's not, because that's not, is it? That's those go up, they're credit. So it doesn't line up. It's just not as neat in there. It's crept in somewhere over the last 25 years. I'm not quite sure why, because we never used to be taught like this in here. And so the leftover method of that really, it's actually the statement of financial position. It's the balance sheet. Yeah, so it's a statement of accounts rather than the accounting equation. Not quite sure where it's crept in over the last 25 years, but this was not taught 25 years ago when you used to do double entry bookkeeping by hand. Then we've got the last one, DEAD CLIC. And so in terms of DEAD CLIC, it's a mnemonic, and it's got debits, which are expenses, assets, and drawings. So if you see one of these, it's a debit, and then credits. If you see one of these, it's a liability and income and capital. And we've got the opposite, which is pearls. Purchase expense and assets on the left hand side, and the debit side. We've got this sort of revenue, liabilities, and sales on the right hand side, the credit side, and a T account. So why does DEAD CLIC fail? And it fails badly. Well, journals have two sides that equal each other. Yeah, so you've got journals that got two sides that equal each other, and you've got debits. So debits equals credits in here. But what happens when we buy a car? Well, the bank's an asset, all right, so that's a debit. The bank's an asset, it's an asset. The car's an asset, that's a debit, isn't it? Yeah. Right, no, it's not. But how we get this here? So what we're getting, the students who use DEAD CLIC tend to produce, the wrong-sided entries in a double entry bookkeeping, especially when they start to get into VAT. VAT on purchases. VAT on purchase, well, that's a credit. Yeah, but the VAT on a purchase is a debit. So because it's money in the future, because the VAT, well, actually, it's a reduction of the money out in the future, so it's a reduction of the VAT in there, so it's a debit. And if it's too much, in terms of you got too much, VAT, you pay too much more VAT than you take in sales, and then you get it paid back, so it becomes an asset. So it definitely fails when you start to look at VAT and fixing of errors. So the other side, well, just reverse the one going down. Well, which one's going down? I don't quite get it. I'm not understanding what the heck's going on. And if I look at a bank statement, when it goes down, it's a debit. Which one's going down? So it's total nonsense. Basically, there's no saving it or whatever. It's just a pile of trash. So why is dead click taught if it is a pile of trash? Well, at level 2, there's this trial balance question really in here. So you'll have this idea of take the opening balances and put them in. So you can go down and go, okay, asset, debit, sale, credit, purchases, debit, purchase returns. Oh, right, okay, opposite round. Is it? What is it? Oh, it's got purchases, but it's returns. Okay, actually it's a credit. Purchase ledger control. Okay, that's a as a credit in there though. Right, so we're going through these ones and we can just go through and tick off and we can put them in the little balance sheet, whoop-de-doo. And so that you can scrape a pass at level 2 using dead click. The problem is that you've not really learned anything about why double entry bookkeeping is working, and so at level 3 then it doesn't work. VAT is introduced, which is going backwards and forwards because it could be a debit or a credit based on whether it's a purchase or a sale. And then also as well you introduce errors and also the extended trial balance. It just fails at level 3 and it will break down at that point, or any higher level in there. So the leftover method is explaining the accounting equation, but it doesn't really set up neat T accounts and creation of journals. That's its big weakness really, and so people can't really sort of see how those journals are created. It doesn't come naturally then, and then is struggling when we're starting to produce error questions and when we're doing VAT. Dead click allows a poor pass at level 2, but you will have to undo it already. The hope is in this one is if you teach this method is that it might just click between level 2 and level 3. Actually what happens is people just get swamped in level 3 in advanced bookkeeping and then just get completely lost. As soon as we start to introduce VAT and fixing of errors, really the examiner's testing to see whether you passed using dead click there. Money in, money out. It's the way that it used to be taught 25 years ago when I myself used to produce manual books of account. I used to train as an audit junior, and so you'd produce manual accounts in there, and if you've got thousands of these sort of transactions going backwards and forwards, really you have to be very, very methodical, and money in, money out is a very methodical method. Hopefully that was helpful. See you on the next one. Bye-bye.